You know what nobody talks about? The single number that separates smart silver buyers from people throwing money away. And I'm not talking about the spot price. I'm talking about something that could be costing you hundreds, maybe thousands of dollars every single time you buy silver. And most people have no idea it even exists. Let me show you what I mean. Last week, a guy walked into a coin shop in Phoenix with $10,000 cash, ready to buy silver. He knew the spot price was around $31 per ounce. He did his homework, or so he thought. He walked out with 250 ounces of Silver Eagles. Felt pretty good about himself. Here's the problem. He just overpaid by $1,847, and he has no idea. How do I know this? Because 3 hours later, another buyer walked into the same shop with the same $10,000. She walked out with 312 ounces. Same day, same shop, same spot price. But she knew the one thing the first buyer didn't. And that difference? That's 62 extra ounces of silver. That's real wealth. That's the difference between building a position and getting fleeced. So what's this magic number everyone's missing? It's called the premium. And right now, in this market, understanding premiums isn't just important. It's the difference between winning and losing in silver. Because here's what's happening that nobody's telling you. The spread between what you should pay and what dealers are charging has never been wider. And it's not by accident. Let me take you back to March 2020. Remember that? Everything shut down. Stock market crashed. And something interesting happened in the silver market. Something that revealed exactly how this game really works. The spot price of silver dropped to $12 an ounce. $12. You'd think that was the buying opportunity of a lifetime, right? Wrong. Because while spot was at $12, try finding physical silver for less than $20. Some dealers were charging $25, $28, even $30 for Silver Eagles. Think about that. The price said $12, but you couldn't actually buy it for less than $20. That's a 67% premium. And that's when I realized most people don't understand what they're actually paying for. See, there are two silver markets. There's the paper market, where banks and institutions trade contracts on the COMEX. That's where the spot price comes from. Then there's the physical market, where real metal changes hands. And these two markets? They're not the same thing. Not even close. The spot price is what silver trades for in 1,000-ounce bars between institutions. But you're not buying 1,000-ounce bars. You're buying coins, rounds, or smaller bars. And that difference? That's where premiums live. That's where your money disappears if you don't know what you're doing. Here's how premiums actually work. Let's say spot silver is $31. You want to buy a Silver Eagle. The mint charges the dealer about $2.50 over spot to produce that coin. So the dealer's cost is $33.50. Then the dealer adds their markup, usually $3 to $5 per coin. So you're paying $36.50 to $38.50 for that Silver Eagle. That's a premium of $5.50 to $7.50 per ounce. On a $31 spot price, that's 18% to 24% over spot. And here's the thing. That might be totally reasonable. Or it might be highway robbery. Depends on what else is available. Because not all silver products carry the same premium. Silver Eagles? High premium. Usually $6 to $8 over spot. Canadian Maples? Usually $4 to $6 over spot. Generic rounds? Maybe $2 to $4 over spot. 10-ounce bars? Often $1.50 to $3 over spot per ounce. 100-ounce bars? Sometimes as low as $1 over spot per ounce. Same silver, same purity. Wildly different premiums. And this is where people lose money. They walk in, see Silver Eagles, think, that's what I should buy, and never ask about the alternatives. Let me give you a real example. Guy I know, let's call him Robert, decided to start stacking silver in 2021. He had $50,000 to invest. He went to a reputable dealer, asked for Silver Eagles, and bought 1,250 ounces at $40 per ounce when spot was $26. He paid a $14 premium per ounce. That's $17,500 in premiums alone. Now, Silver Eagles are beautiful coins. They're recognizable. They're liquid. But here's what Robert didn't know. He could have bought 1,850 ounces of generic rounds for that same $50,000. That's 600 extra ounces. Same silver content, same .999 purity, but 48% more metal.
Fast forward to today.
Spot silver is around $31. Robert's 1,250 Silver Eagles are worth about $46,250 if he sells them back at $37 each, accounting for the premium he'll get back. Not bad. He's down $3,750 from his initial investment, but he's got recognized coins. But if he'd bought those 1,850 generic rounds, they'd be worth about $59,200 at $32 per ounce. That's $9,200 more. That's the premium trap. And Robert's not alone. This happens every single day. Now, I can already hear what you're thinking. But Silver Eagles hold their premium better. They're more liquid. They're government issued. And you're right. Sort of. Silver Eagles do tend to hold premiums better than generic rounds. When you go to sell, you'll probably get $3 to $5 over spot for an Eagle versus $1 to $2 for a generic round. But here's the math that matters. If you pay $7 over spot for an Eagle and get back $4 over spot when you sell, you lost $3 per ounce to premium compression. If you pay $3 over spot for a generic and get back $1.50 when you sell, you lost $1.50 per ounce. You're still ahead with the generic. Unless Silver Eagles maintain that $3 to $4 premium advantage forever, which they don't always do. And here's what really matters. When silver moves, it moves on the spot price. If spot goes from $31 to $50, that's a $19 gain per ounce. Whether you own Eagles or generics, you capture that $19. The premium is just overhead. It's the cost of entry. And the lower that cost, the more leverage you have to the actual silver price movement. This is what the big players understand. This is what the institutions know. They're not buying Silver Eagles. They're buying 1,000-ounce bars at 50 cents over spot. Because they understand that premiums are friction. They're a tax on your returns. And the less you pay, the more you make. But here's where it gets really interesting. Premiums aren't static. They move. And understanding why they move is how you can actually use this to your advantage. Because right now, we're in a premium environment that's telling us something important about what's coming in the silver market. Let me show you what I mean. In normal markets, Silver Eagle premiums run about $3 to $4 over spot. That's the baseline. But watch what happens during supply crunches. In 2015, premiums were $2 to $3. Market was quiet. Plenty of supply. Then 2016 happened. Silver ran from $14 to $20. Premiums spiked to $4 to $5. Why? Because when price moves up, demand surges. Mints can't keep up. Premiums rise. Then 2020 hit. Premiums went to $8, $10, even $12 over spot. The U.S. Mint couldn't produce enough Silver Eagles. They were rationing to dealers. Some dealers stopped selling entirely because they couldn't get inventory. And here's the key. Those premium spikes happened before the big price moves. Premiums led the spot price. Think about what that means. Premiums are a real-time indicator of physical demand. When premiums rise, it means people are buying physical metal faster than it can be produced. That's a supply-demand imbalance. And that imbalance eventually shows up in the spot price. Because the paper market can only diverge from the physical market for so long. Eventually, reality catches up. And when it does, spot price moves to meet physical demand. This is exactly what happened in 2020 and 2021. Premiums spiked in March 2020. Spot price followed 6 months later, running from $12 to $30. Now look at where we are today. Silver Eagle premiums are running $6 to $8 over spot. That's elevated. Not 2020 levels, but well above the historical average. Generic round premiums are $3 to $4, also elevated. The U.S. Mint is producing Silver Eagles at near record levels, but they're still struggling to keep up with demand. Dealers are reporting inventory constraints. And here's the thing. Spot price is only at $31. It hasn't moved yet. But the physical market is already tightening. The premiums are telling you something. They're saying demand is here. Supply is tight. And the spot price hasn't caught up yet. This is the opportunity. Not to overpay for high premium products, but to understand what the premium structure is telling you about where the market is going. Because if you know premiums are elevated because of supply constraints, you know the smart move is to buy the lowest premium products you can find before spot price catches up. You're not trying to time the premium. You're trying to get the most metal for your money before the whole market reprices higher. Let me give you the framework for how to actually do this. First, you need to know what premiums should be. Here's the baseline for normal markets. Silver Eagles, $3 to $4 over spot. Canadian Maples, $2.50 to $3.50 over spot. Generic rounds, $1.50 to $2.50 over spot. 10-ounce bars, $1 to $2 over spot per ounce. 100-ounce bars, 50 cents to 1.50 over spot per ounce. 1,000-ounce bars, 30 cents to 75 cents over spot per ounce. That's your baseline. Anything significantly above that, you're overpaying unless there's a specific reason. Now, here's how to shop. Don't just go to one dealer. Check at least 3. Online dealers like APMEX, JM Bullion, SD Bullion, and Monument Metals all publish live pricing. Compare premiums across products and dealers. You'll be shocked at the variance. I've seen the same product with a $2 per ounce difference between dealers on the same day. That's real money. On a $10,000 order, that's $600, just for shopping around. Second, understand the premium tiers. Government coins like Eagles and Maples carry the highest premiums because they're legal tender, government-backed, and widely recognized. But here's the secret. That recognition premium only matters if you're planning to sell to retail buyers. If you're selling back to a dealer, they're going to test the metal anyway. They don't care if it's an Eagle or a generic round. They care about the silver content. So unless you specifically need the recognition factor, you're paying for something that doesn't add value when you sell. Private mint rounds are the middle tier. Companies like Sunshine Minting, Asahi, and Scottsdale produce high-quality rounds with anti-counterfeiting features. Premiums are usually $2 to $4 over spot. You get quality, recognizable products, but you're not paying the government coin premium. This is often the sweet spot for stackers who want quality without overpaying. Then you've got bars. 10-ounce bars, 100-ounce bars, 1,000-ounce bars. The bigger the bar, the lower the premium per ounce. Why? Because it's cheaper to produce 100-ounce bar than 101-ounce rounds. Less labor, less packaging, less handling. Those savings get passed to you in the form of lower premiums. If you're buying for weight and you don't care about divisibility, bars are almost always the best value. But here's the catch. Liquidity and divisibility matter. A 1,000-ounce bar is cheap per ounce, but good luck selling it quickly. You need a buyer with $31,000 cash. 1-ounce coins and rounds? You can sell those anywhere, anytime. So there's a trade-off. Lower premiums versus higher liquidity. The smart play? A mix. Core position in low premium bars for maximum metal. Smaller position in coins and rounds for liquidity and flexibility. Now let me tell you about the premium trap that catches even experienced buyers. It's called premium compression, and it's how people lose money even when silver goes up. Here's how it works. You buy Silver Eagles at $8 over spot, when spot is $31. You're paying $39 per ounce. Silver runs to $40. You're excited. You're up. You go to sell. Dealer offers you $43. That's only $3 over spot. You just lost $5 per ounce in premium compression. Your $39 investment is worth $43. That's only a $4 gain on a $9 move in spot. You captured 44% of the spot price move because premiums compressed. This happens all the time. When spot price rises quickly, premiums tend to compress. Why? Because the premium is a fixed dollar amount, but it's quoted as a percentage of spot. When spot is $20 and premiums are $4, that's a 20% premium. When spot is $40 and premiums are $4, that's a 10% premium. Same dollar amount, lower percentage. But here's the thing. When you sell, dealers often pay based on percentage, not dollar amount. So as spot rises, the dollar premium you get back often shrinks. This is why buying high premium products is dangerous. You're betting that premiums stay elevated, and they usually don't. The flip side? When spot crashes, premiums spike. We saw this in 2020. Spot dropped to $12, but premiums went to $8 to $10. Why? Because physical demand surged while paper price collapsed. People wanted real metal, not paper contracts. So physical premiums disconnected from spot. If you bought at $12 spot plus $8 premium, you paid $20. When spot recovered to $20, you broke even. But if you'd bought at $12 spot plus $2 premium, you paid $14. When spot hit $20, you were up 43%. Same spot price move. Wildly different returns. All because of premiums. This is why timing your premium entry matters as much as timing your price entry. And right now, with premiums elevated but spot price still relatively low, the math says, wait for premium compression, or buy the lowest premium products available. Don't chase high premium coins when spot is at $31 and premiums are $7. That's a $38 entry point. If spot goes to $50 and premiums compress to $4, you're at $54. That's a 42% gain. Not bad. But if you buy at $31 spot plus $2 premium, you're in at $33. Same $50 spot with $4 premium puts you at $54. That's a 64% gain. Same ending point. 50% better return. Just because you paid less premium going in. Now here's where this gets really important for what's happening right now in the silver market. Because we're not just talking about saving a few bucks on premiums. We're talking about positioning yourself for what could be the biggest silver move in decades. And if you overpay on premiums now, you're going to miss a huge chunk of that move. Let me explain why. Silver is setting up for a supply crisis. Not a shortage, a crisis. The kind we haven't seen since the 1970s. And it's not just about investment demand, it's about industrial demand colliding with declining supply. Solar panels alone are going to consume 20% of annual silver production by 2027. Electric vehicles use twice as much silver as combustion engines, 5G infrastructure, AI data centers, defense systems. All of them are silver intensive. And production? It's not keeping up. Primary silver mines are declining. Most silver comes as a byproduct of copper, lead, and zinc mining. And those operations are facing their own challenges. Here's the number that should terrify anyone short silver. The silver market ran a 200 million ounce deficit in 2023. That means demand exceeded supply by 200 million ounces. Where did that silver come from? Above ground inventories, stockpiles, reserves. And those reserves are finite. The Silver Institute estimates we've got maybe 3 to 5 years of deficits before above ground supplies are exhausted. Then what? Price has to rise enough to either destroy demand or incentivize new production. And given how silver intensive the green energy transition is, demand destruction isn't likely. Which means price has to rise. A lot. Now, if you're sitting on retirement accounts and you're thinking about how to protect wealth while potentially capturing this move, there's something you should know. You can actually hold physical silver in a retirement account. It's called a self-directed IRA, and it allows you to hold IRS-approved precious metals. I put together a free guide that walks through exactly how this works, what the rules are, and how to do it without triggering taxes or penalties. If you've got $100,000 or more in retirement accounts, and you're interested in adding physical silver exposure, check the description. It's worth understanding your options. All right, back to premiums. Here's why this supply crisis matters for premiums. When supply gets tight, premiums explode. We saw it in 2020. We saw it in 2011. We saw it in 2008. Every time physical supply gets constrained, premiums spike. And here's the thing. They spike on everything. Eagles, maples, rounds, bars, everything. But they spike most on the high premium products, because those are what retail buyers chase, and retail buyers are the last ones in. They're the ones who panic buy when silver is already moving. They're the ones who pay $15 over spot for silver eagles when spot is at $35. They're the ones who get crushed when premiums compress on the way down. The smart money? They're buying now. They're buying the lowest premium products they can find. They're accumulating weight. Because they know that when silver moves, it's going to move fast. And the people who have the most ounces are going to make the most money. Not the people with the prettiest coins, the people with the most metal. This is the game. This is how you win. So let me give you the actual playbook. If you're buying silver right now, here's what you do. First, decide how much you're allocating. Let's say it's $10,000. Don't blow it all on silver eagles at $7 over spot. That's $38 per ounce. You're getting 263 ounces. Instead, split it. Put $3,000 into silver eagles or maples for liquidity and recognition. That's about 79 ounces at $38. Put $7,000 into the lowest premium products you can find. Generic rounds at $3 over spot. That's $34 per ounce. That's 206 ounces. Total? 285 ounces. That's 22 more ounces than if you'd bought all Eagles. And you still have 79 ounces of recognized government coins for liquidity. But here's the advanced move. If you're buying larger amounts, go even heavier into bars. 10-ounce bars at $2 over spot per ounce. That's $33 per ounce. 100-ounce bars at $1 over spot. That's $32 per ounce. On that same $10,000, if you put $2,000 into Eagles for liquidity and $8,000 into 100-ounce bars, you're getting 53 ounces of Eagles plus 250 ounces in bars. That's 303 total ounces. That's 15% more metal than the all Eagles approach. And when silver goes to $50, that extra 40 ounces is worth $2,000. That's real money. That's the premium game. Now, here's the thing nobody tells you about selling. When you go to sell silver back to a dealer, they're going to pay you based on their buy prices, not their sell prices. And their buy prices are always lower than spot plus premium. Usually, dealers pay spot plus $1 to $2 for Eagles, spot plus 50 cents to $1 for Maples, and spot minus 50 cents to spot plus 50 cents for generic rounds. Bars? Often spot minus 50 cents to spot flat. So when you're calculating your real return, you need to factor in the sell-side premium compression. This is why buying low-premium products matters even more. You're not losing as much on the round trip. Let me show you the math. You buy a silver Eagle at $38 when spot is $31. That's $7 over spot. Silver goes to $50. Dealer pays you $52. That's $2 over spot on the sell side. Your gain is $14 per ounce on a $19 spot move. That's 74% of the spot move. Now, you buy a generic round at $34 when spot is $31. That's $3 over spot. Silver goes to $50. Dealer pays you $50. That's 50 cents over spot on the sell side. Your gain is $16.50 per ounce on the same $19 spot move. That's 87% of the spot move. You captured 13% more of the move just by buying lower premium products. And that's assuming premiums compress. If premiums stay elevated or expand, the math gets even better for low premium products. Here's another angle most people miss. Premiums vary by quantity. Dealers offer volume discounts. If you're buying one silver Eagle, you might pay $8 over spot. But if you're buying a monster box of 500 Eagles, you might pay $6 over spot. That's $2 per ounce savings. On 500 ounces, that's $1,000. Same product, same dealer, just buying in bulk. This is how serious stackers operate. They buy in quantity to minimize premiums. And if you can't afford a monster box, go in with friends or family. Pool your money, buy the box, split the coins. You all save on premiums. Same thing with bars. A single 10-ounce bar might be $2.50 over spot per ounce. But if you buy 10 of them, you might get $1.50 over spot per ounce. That's $10 per bar savings. On 10 bars, that's $100. And 100-ounce bars? The premium difference between buying 1 and buying 10 can be 50 cents per ounce. On 1,000 ounces, that's $500. This is real money. This is how you maximize your metal for your dollar. Now let's talk about the premium products that are almost never worth it. Proof coins, colorized coins, commemorative editions, special releases. These products carry massive premiums, sometimes $15, $20, even $30 over spot. And here's the thing. When you go to sell, you're getting maybe $2 to $3 over spot. Unless you find a collector who specifically wants that exact coin, you're selling it for melt value. All that premium you paid? Gone. This is the numismatic trap. Dealers love selling these products because the margins are huge. But for stackers, they're almost always a bad deal. You're paying for collectability that doesn't exist when you sell. The only exception? True numismatic coins with actual collector value. Pre-1933 gold coins. Key date silver dollars. Rare mint errors. These can actually appreciate beyond their metal content, but you need to know what you're doing. You need to understand grading, rarity, and market demand. For most people, this isn't worth the complexity. Stick to bullion. Stick to weight. Stick to low premiums. That's how you build wealth in silver. Here's the premium strategy that almost nobody uses but should. Dollar cost averaging with premium awareness. Instead of buying all your silver at once, buy in increments. But here's the key. Track premiums. When premiums are low, buy more. When premiums are high, buy less or wait. This way, you're not just averaging your spot price entry, you're averaging your premium entry. And over time, this can save you thousands. Let me give you an example. You're planning to buy $12,000 worth of silver over 6 months. That's $2,000 per month. Month 1, premiums are $7 over spot. You buy $1,000 worth instead of $2,000. Month 2, premiums drop to $4 over spot. You buy $3,000 worth. Month 3, premiums are back to $6. You buy $1,500. You continue this pattern, buying more when premiums are low and less when they're high. At the end of 6 months, you've spent your $12,000, but you've accumulated more ounces because you weighted your purchases toward low premium periods. This is advanced, but it works. Now, here's what's happening right now that makes all of this urgent. The silver market is in the early stages of a structural shift. For decades, silver traded like an industrial metal with some monetary characteristics. But that's changing. Silver is becoming a strategic metal. Governments are recognizing that silver is critical for energy transition, defense systems, and technological infrastructure. And when something becomes strategic, governments start stockpiling. China's been doing this for years. They're accumulating silver quietly through state-owned enterprises. Russia's doing the same. Even the US is starting to wake up to the fact that silver supply chains are vulnerable. What happens when governments start competing with industry and investors for limited silver supply? Price goes vertical, and premiums, they explode. Because when governments buy, they buy big. They buy everything available, and retail investors get priced out. This is what happened with palladium in 2018-2019. Automotive demand collided with investment demand. Supply couldn't keep up. Price went from $800 to $3,000 in 18 months. Premiums on physical palladium went from $20 to $200 over spot. People who bought early at low premiums made fortunes. People who chased at high premiums got crushed. Silver's setting up the same way. And if you're paying $7 to $8 over spot for Silver Eagles right now, you're already late. You're already overpaying. Because when silver goes to $50, $60, $75, those premiums are going to compress. And you're going to realize you paid $38 for silver that's worth $52. You made money, but you left a fortune on the table. The people who bought at $33 with low premiums, they're the ones who are going to make life-changing wealth. This is the game. This is what separates the winners from the losers in silver. It's not about timing the exact bottom. It's not about catching the perfect entry. It's about maximizing your ounces per dollar. It's about understanding that premiums are overhead, and overhead kills returns. It's about being smart, being patient, and being ruthless about getting the most metal for your money. So here's what you do right now. Go to 3 different online dealers. Pull up their pricing. Look at Silver Eagles, Canadian Maples, generic rounds, 10-ounce bars, and 100-ounce bars. Write down the premiums for each. Calculate how many ounces you can get for your budget with each product. Then make your decision based on the math, not the marketing. Don't buy Silver Eagles because they're pretty. Buy them if the premium makes sense for your strategy. Don't avoid bars because they're not as liquid. Buy them if you're maximizing weight and you have other liquid assets. And here's the final piece. When you buy, think about your exit. How are you going to sell? If you're planning to sell back to a dealer, low premium products make sense because you're not losing much on the round trip. If you're planning to sell to other investors or collectors, recognized products like Eagles might be worth the premium. If you're holding for decades and you think silver's going to $100 or $200, premiums matter less because the spot move will dwarf the premium.